Now we're at section 954. We've talked some about 951, where the inclusion in income is and the definition of U.S. shareholder. We've talked a bit about 952, which includes the definition of subpart F income and these deficit rules. And now we're up to 954. We've ignored 953, which is solely about the insurance industry. So we're now at 954A. And we're going to spend a reasonable amount of time on 954 because it's really the heart of your subpart F, because it defines the activities which are the tax haven activities. Now, notice that we mention here that the definitional sections of 954C, D, and E, which deal respectively with foreign personal holding company income, foreign-based company sales income, and then services income. Those three are focused on gross income. Anything in those is a gross income calculation. On the other hand, the amounts as defined in 954A, which is where you say what is foreign-based company income, which is again a specifically defined term. That number is a net income number because it's there's a rule in 954B5 which says you allocate expenses to get to the amount of net income for each type of subpart F income. So the definitional sections are gross income, the amount that gets carried eventually to 951 and included in the shareholder's income, that's a net income amount. 954B has a few special rules which we'll mention briefly. The first one is a de minimis rule. Basically saying if you only have a little bit of subpart F income, only a little bit of tax haven income, don't worry about it. You can pretend you have zero. And that little bit is defined as the lesser of 5% of gross income or $1 million. So if you're talking about a very large company where $1 million that has more than 20 million of gross income, then the limit will be 1 million. If you're talking about something smaller, then 5% will be smaller than that. So a basic de minimis rule. And then secondly, on the other side of the coin, if you have so much foreign-based company income, you have so much of this subpart F income that you are above 70% or 70% or higher, then you have to treat 100% as being foreign-based company income, and ultimately bring all of the net income from that up to the U.S. shareholder. So de minimis and maximum. Yes.
So then you're looking at the gross income of the CFC, not like.
Yeah, the gross income of the CFC, not the group, just the entity. Yeah, what you bring up is a good comment, and maybe it's worth a word or two more, and that is that let's say the the normal situation is that you are looking at everything in the tax world on an entity-by-entity basis. Entity-by-entity basis. There are some exceptions, but they aren't that common. The major exception that you'll run into in a career in the tax area in the United States is the consolidated return rules here, where you sort of, you do the tax return pretty much ignoring entity lines. I don't remember whether I said anything about this when we talked about, let's say, methodology back in the first session. But you have to think on this entity-by-entity basis, but the client who you're talking to, whether operational person or financial person, normally does not think along those same lines. They think along divisional lines or product lines or service lines or whatever the nature of their business is. If you ask a lot of people, who's your employer? They'll say, gee, I work for General Motors. Well, yeah, but General Motors might have 500 different companies. Which one do you have an employment contract with? Geez, I don't know. Well, we have to worry about the specifics on an entity-by-entity basis. That's the usual situation for us. So, very good question. Now, if you have a controlled foreign corporation and it's earning income which is defined as tax haven income by these later sections we haven't gotten to yet, or these later subsections we haven't gotten to yet. If you happen to be paying a high effective foreign tax rate on it, on that tax haven income, well, it doesn't sound like it's real tax haven income if there's high foreign taxes on it. So there's an exception that says, well, if you establish that this income actually is subject to a high foreign tax, then you don't have to treat it as subpart F income. Obviously, the logic is no intent to avoid U.S. tax, therefore it doesn't have to be covered by subpart F. To go to an example, some of you may have looked at this example from our group, our course fact pattern, where there are branches in Japan and Hong Kong. And one part of that was that after the branches have been incorporated, you have the sale of product from the U.S. to the subsidiaries in Japan and Hong Kong, and then sales to customers outside of Japan and Hong Kong. Now, again, we haven't gotten quite yet to the definition of foreign-based company sales income, but those transactions manufactured in the U.S. by Win, sold to Win subsidiary in Japan and separately Win subsidiary in Hong Kong, and then sold to customers outside of those two countries, that will be foreign-based company sales income. Now, why are we bringing this up at this point? These sales would be subject in Japan, or any profit from these transactions would be taxed in Japan at roughly 41%, but in Hong Kong at only 16.5%. We've just talked about this rule, if we go back a step, where income is high taxed. Well, this is an example of where there might be high tax on something that is a foreign-based company income item. As a result of this, if we wanted to, we could arrange for the income that Japan earns not to be foreign-based company income that generates a subpart F inclusion. Now, would there be any situation where a company would, let me go back a step. The way the rule works is that if you do nothing, then you will include the amount in your U.S. income, the U.S. shareholders' income. If you establish, you have the option, in essence, to establish that there is a high tax and that you do not want to include that income in your U.S. shareholders' income. Now, is there any reason why a company would want to or not want to include that income that's high tax?
You didn't, you get the credit, right? If you
Yeah.
didn't, you get the foreign tax credit.
Yeah, exactly.
But if you already have foreign tax credit, then you wouldn't need it.
Yeah. Because if, in this case, Win has excess foreign tax credits already, so it doesn't need more. So would it be, because it doesn't need more now, would it be better off to specifically not have the 951 income inclusion now? And if yes, why?
Well, I don't know if this answers your question, but can't you, isn't there like, if you have excess foreign tax credit, you can use that beyond just the current year?
Yes, there's 1 year carried back and 10 years carried forward. And you're on the right track, so keep going.
So if you're expecting profits in a high tax country, you can accumulate your foreign tax credit to use when you're back and 10 years forward. Would that be?
Well, we're saying in this particular case, we're saying that Win already has, here's Win up here. Here's its two subsidiaries, Japan, Hong Kong. We know that the rate down here, let's say, is 41%, and over here is 16.5%. Now, if Win up here already has excess FTCs, yes.
I think I know. So you could use the high tax exemption and then save your foreign tax credit.
Okay, you're putting together what the two of you have said. Yeah, putting it together. Yes, you only trigger the start of that 1 year back and 10 years forward from the year when you actually bring it in, bring the foreign tax credits, bring the deemed paid credits into the U.S. return. And if you have that subpart F inclusion this year, you start it this year. If you say, wait, I already have some excess foreign tax credits that I need to use. let's wait, let's use this high tax exception. Let's leave the deemed paid credits down inside the subsidiary, not bring them up today, but bring them up at some point in the future when I no longer have excess foreign tax credits. And can I choose, in a sense, when I want to bring them up? Well, yes, you can, because you have two routes. One is to pay an actual dividend. You can choose when to pay an actual dividend. That's totally the choice of the shareholders of the company through their power to control when the subsidiary declares a dividend. But let's say that, well, gee, we're using all of our money in the business. We don't have, liquid funds to be able to pay a dividend, when it's finally that year when we want to trigger it. So that's interesting. We have our investment in U.S. property rules, and if we can structure an intentional investment in U.S. property, then we are able to just manufacture a distribution which carries those deemed paid credits up into the parent. Now, is it easy to create a 956 investment in U.S. property? Well, it can be pretty easy. All you'd have to do as a practical matter is to go to let's say the parent company's banker that's already lending the parent company money and saying, gee, I want to sign a guarantee so that I'm giving let's say we're creating a security interest that's backing the loan you're already making to the parent, and you'll just have more security for your loan because I, the CFC, am allowing my assets to be used as security for repayment of that loan. Well, that's an investment in U.S. property. So it can be as easy as that. Now, we're creating a real legal document that gives the bank some legal rights, but maybe as a practical matter, we don't care. So there's a lot of ability to control when deemed paid credits come up. And if we can defer, for example, for 5 years, let's say, when we bring those deemed paid credits up, then maybe we're much better off because we have 5 more years on that 10-year carry forward period. This slide should look pretty much like what you have seen before in regard to the 904 calculation of foreign source taxable income. And why does it look the same? Well, again, because those 861-8, -9, -10, -11, and so on, those allocation of deduction rules apply consistently in a number of different places. So those rules, 861-8 and so on, are to be used in calculating that net income that I mentioned in, for purposes of 954A definition of foreign-based company income. Because again, that's a net income amount which ultimately goes up to the shareholder. Okay, now we're looking at the first of the 3 principal types of foreign-based company income, and that's foreign personal holding company income. And you'll see a number of categories. The first one, of course, is very broad and includes the normal things you would expect, the dividends, interest, royalties, rentals, things like that. Notice gain from sale or exchange of certain property. That's essentially your capital gains from sale of stock or securities or real estate, that sort of thing. Let me give an example, a brief example of something regarding sale or exchange of property, which, again, I hope will try to give you a little bit of a bigger picture as to how your mind has to think about these things. This was something that happened when I was in Japan many years ago and was doing some work for a major U.S. oil company which was operating in Japan. We'll call this X. They had a Japanese subsidiary. Actually, they had a number of them, but we'll just focus on one. Up at this level, they had large capital loss carry forwards.
No deal protection.
Pardon? Oh, picky again. Thank you. They had large capital loss carry forwards at the U.S. level. And the subsidiary, and again, there were a number of subsidiaries, they each owned a physical gas station. They had a number of locations around Japan where they had gas stations. Now, they decided that they wanted to get out of the gas station business, at least for a number of locations, which meant they were going to sell each piece of real estate and the gas station that sat on it in a number of places around Japan. And if you know anything about what happened in the Japan bubble, real estate prices were very high. So they were looking at some rather large gains. Now, if there is a sale of a gas station, that's there's a pump out front. If there's a sale of a gas station, and if we have said that gain from the sale of property is subpart F income, and there will be a subpart F inclusion. Now let's ignore for a moment the high tax rule, because that's not the point I want to make with this example. There's going to be a subpart F inclusion. And what's the character of that subpart F inclusion? Ordinary. It's ordinary income. So even though there's something that would be a capital gain at the Japanese company level, there's ordinary income inclusion at the U.S. shareholder level. And the large capital loss carryovers, they just sort of sit there and don't get utilized. Now, let's pretend that we have the check the box rules here. And let's assume that the Japanese subsidiary is an eligible entity under the check the box rules. Could we make an election to treat this company as being a disregarded entity? We could. And what will the character be to X of the sale of that real estate? Yeah, you'll end up with capital gain when you sell. Now, in this discussion, I'm ignoring a lot of other potential rules that could come in and look at this, but the point is that it's not just about foreign tax credits, which has been a lot of the discussion we've had, but there can be other reasons why you might want a disregarded entity status instead of a CFC status. If you can sell the property, realize capital gain because now because of the disregarded entity status, X is the taxpayer. X now has capital gain and has capital loss carryovers that it can use against that gain. So again, another example of how you've got to, in a sense, always be on the lookout for, gee, can I change the rules of the game by this kind of election that can be made under the check the box rules? It changes your whole outlook. Yes?
I think I missed something. So when the gas station is sold and it's treated as subpart F income, when it's included in X's income, it's considered ordinary income, regardless of...
Oh, okay. If there's two possibilities. One is that the Japanese sub is treated as a corporation, in which case it is a CFC. Or the other alternative, the box is checked. It's treated as the sub is treated as a disregarded entity, and subpart F goes away because we don't have a foreign corporation for U.S. tax purposes. Again, this gets to the real importance of this concept of disregarded entity. It's sort of like, an unnatural act. It's sort of how do you get your hands around it and understand it. There is a real Japanese company. It exists for every legal and operational purpose and contractual purpose. It really exists. But if we make that disregarded entity election, that check the box election, for U.S. tax purposes only, we pretend that it does not exist. And once there's no longer a Japanese corporation for U.S. tax purposes, well, subpart F is irrelevant. Subpart F, could not, you could say it doesn't exist. So it's the one or the other. You can't have it both.
I guess my question is,
Yeah.
for subpart F, then are you saying that character of income doesn't matter?
Oh, yeah, correct. Well, let's get more basic than subpart F. Let's just assume we have shareholder and we have foreign subsidiary. Let's forget subpart F. Let's just say we have U.S. person owns a foreign company. If that foreign company realizes earnings because it sold an asset and had a capital gain, that creates earnings and profits. If you now say, gee, the Japanese subsidiary is going to declare a real dividend out of those earnings and profits, a real dividend, X is going to receive a real dividend. What is the character of that dividend income? Ordinary. So the basic law itself already transforms what would be capital gain at that subsidiary level into ordinary income to the shareholder. So the reason I brought this up is that because the check the box rule allows you to ignore the existence of that Japanese company, treating the activities there as a disregarded entity, treating the activities as if they were owned directly by X, that allows X to actually have capital gain when the property is sold. Yes, Glenn?
Like recently learned that accumulated earning tax, you can avoid that by just paying a dividend. Is Subpart F similar to that? Can you just avoid Subpart F if you just pay the dividend amount that would?
Actually, the answer is no. If you go through the mechanics of Subpart F, you see that the amount of Subpart F income is determined first. Then, once you have the Subpart F income, which is included in the shareholder's income, you then say, okay, gee, were there any actual distributions during the year? And those distributions are now considered to be made out of previously taxed income, which is your 959. We'll get to that later, but it's a rule that essentially says there will not be a double counting of tax haven income that's ultimately taxable to the shareholder. There will not be a double counting when there's later an actual distribution. And the order is that you first calculate the Subpart F income, then you look at the distribution that occurred in actual fact during the year, and you say, okay, how much was that distribution? Do we have previously taxed income because we've already recognized it as Subpart F income at the shareholder level? And if it's already recognized, then we don't recognize it a second time. It's a good question. Okay, so getting back to this listing, notice the fourth one, gains from foreign currency transactions. What that means essentially is that there can be gains or losses if a subsidiary, for example, which uses the yen as its functional currency, happens to have some transactions that are in euros. And as a result, has some exchange gains or losses. Now, again, that's something we'll hopefully cover toward the end of the course, a bit more about those. But that's something which you can run into and is, let's say, the kind of thing which you don't normally think about it. We all grow up within a nice big country where everybody uses the same currency. Maybe you occasionally go to Canada and they use this funny stuff up there. But there can be, this can arise, and foreign currency issues are included in some of the group projects questions which some of you have. Notice also the next one, notional principal contracts. This is essentially swaps and options, those sorts of things. The issue becomes whether there's been legitimate hedging of something and you've identified it as a hedge, or whether you've had some gain from this, maybe either speculatively, or it was an economic hedge against your, an actual transaction, but you did not elect hedging treatment. So This is, again, something that can be unexpected. Personal service contracts, I think we'll talk a little bit more about that on another slide. Notice there are some exceptions. There's recognition that rents and royalties might be earned in an active business as opposed to the normal situation where it's just a passive realization of income. And the regulations have some detailed rules as to how do you decide whether there's a sufficiently active business or not. And since you became accustomed to look through rules under the foreign tax credit limitation, 904D basket rules, they have more of those look-through rules here to decide whether something that is coming from a related company will be passive foreign personal holding company income or not. And we'll later look a little bit more at those look-through rules. For each of the three items, I want to do a very vanilla example, and then we'll get into a bit more detail a bit later. So a vanilla example of foreign personal holding company income is a CFC earning interest on a bond issued by an unrelated company. It's just earning passive interest income. Foreign-based company sales income. If you think about it this way, I think it will be very helpful. We have our CFC, obviously, let's say, owned by U.S. party. And this CFC has gross income from the sale of inventory. Now, the definition is broader than just inventory, but the usual situation is a sale in the normal course of business of your stock and trade. So we have the purchase, we have the sale. And one of the two parties is related. So let's put a line over here so that this one is related to the CFC. And related means over 50% common ownership. Okay, so one factor, two major issues. One factor, a related party is involved. A related party is involved. And secondly, that the country of origination and the country of destination is outside the country of incorporation. So two factors. There's a related party involved and country of origination, country of destination, outside the country of incorporation of the CFC. Now, in this example, I said that X was the seller to the CFC, so a related party is involved. But it doesn't have to be just a case where the purchaser or the seller or the buyer is related, as long as a sale is being made and it is on behalf of a related party. In other words, a related party is somehow involved. So it's broader than just having the seller or the buyer being the related party. And if you notice as you read through this section, there's no requirement. There's no requirement at all that the related party be a U.S. person, be a foreign person. It could, the related party could be anywhere, just as long as it's related, over 50%. Yes, Jessica?
Is it related to the U.S. corporation or related to the CFC?
Well, effectively, it's going to be both under normal circumstances. And I say normal in the sense that you're usually working with large corporations on these kinds of issues because they are multinationals buying and selling to each other. And as a result, usually there's 100% ownership. If you had a situation where, let's say the CFC is a joint venture company, and maybe there's, maybe for example, you have a situation where let's say you have two U.S. companies that get into a joint venture company, or they form a joint venture company, and it's exactly 50-50. Now, this will be a CFC because it's owned more than 50% by U.S. shareholders. Both of these are 10% or greater shareholders. Again, we haven't gotten to the definition of a CFC yet, but we'll get there eventually. So this is definitely a CFC, but neither party is related. Yes, yes, Deb.
In that example that you had, where there were 50-50, I thought it had to be more than 50.
We haven't gotten to the definition of a CFC yet, but the definition, before getting there, is U.S. shareholders, defined as 10% or greater shareholders. U.S. shareholders own more than 50% of the foreign corporation. So there you had two U.S. shareholders. Each of them owned 50%. So in total, they own 100%. They own over 50%. These are very, very rule-based mechanisms. And you just sort of have to go through, through the code over time, learning what they are. Again, you don't have to memorize it. Know that they're there so you can get to them. Know the concept so you realize, hey, I think I have to look for something. So the basic economics is you've got a corporation that's controlled by U.S. persons. And by the way, those U.S. persons, when you look at the details, gee, we only count U.S. persons that are 10% or greater shareholders. But the basic issue is controlled by U.S. persons. Okay, I don't know that this is big enough to see, but this is from 954 D3, which is where related person is defined. And you'll see that it's stock possessing more than 50% of total voting power entitled to vote, or total value of stock of such corporation. So related person is more than 50%. So you can have situations where it's a CFC, but there's no related person for purposes of this rule. While we've got the page up there, I highly recommend you carefully read D1, on your own. You'll see that what you get in there is that dual point. A related party is involved, and the point of origination and point of destination are outside the country of incorporation. Those are your factors. Okay, the vanilla example. Again, sale of product from a related person and the customer in another country. CFC is in country A, customers in country B. So those criteria are met. Related party involvement and point of origination, point of destination outside the country of incorporation. Okay, now to foreign-based company services income. You have similar criteria. Related party involved. And secondly, the services are performed outside the country of incorporation. That location where, when we say it's performed outside, that's physical performance of the services. You could certainly have a case where some services are performed outside, some related services under one service contract are conducted inside, and you'd have to make an allocation in order to come up with the proper amount of foreign-based company services income. Okay, in our vanilla example, the parent contracts with an unrelated customer, contract for construction of a highway, and subcontracts a portion of the job to the CFC. There are some detailed rules on what this involvement of a related party means. And while we could spend time going into details, what I suggest is that you think of this as being related party is somehow involved. I mean, if factually you see that a related party is somehow involved, you figure out what the facts are, then you go to your rules and figure out whether there's enough connection, so that you do in fact meet one of the tests of sufficient relationship so that you have foreign-based company services income. There's a number of special rules in this area, and it can be quite interesting, but you need to look at it with something specific in mind. Let's look at the third one because I think it has a good basic situation, which is definitely not unusual, and which is not too esoteric in what it tries to get across. In this case, we have Win, which has negotiated with some major customer that has itself subsidiaries all over the world. And essentially, it's a sale of software I think we said for $50 million. And in addition, the parent WIN is guaranteeing to the customer that the installation services of installing this software, which they're paying $50 million for, the installation services, which are separate from the cost of the software, is going to be $75 million, or let's say a maximum of $75 million. And that the various WIN subsidiaries in various locations are going to contract directly with, for example, let's say this one is the one in Australia. This one will contract directly with maybe these subsidiaries of the client for the installation services. Maybe these are the subsidiaries in Korea, Japan, Singapore, Malaysia. So the Australian company will contract directly. It's not, that contract does not include WIN. That contract for installation services does not refer to WIN, except maybe in a whereas clause, which provides that, whereas WIN has sold to X certain software, which is being made available to, each of these companies. So this one will therefore perform services to install the software in these for these subsidiaries in the various countries, Korea, Japan, etc.
Is it the
Pardon?
Is it the WIN's subsidiary?
Is it what subsidiary?
WIN's?
Oh, no, these are X's subsidiaries.
Oh.
So these are, in a sense, unrelated customers, unrelated clients. And this one here is the subsidiary of WIN, and it is a CFC. We also said in the fact pattern that these contracts would yield $5 million of revenue, $5 million of revenue from services performed to the Australian company. And that of that $5 million, let's say 80%, or $4 million, would be related to services actually performed in the offices of the clients in Korea, in Japan, in India, in whatever countries are involved. So this kind of situation where there's, let's say, a sale of something by one company in the group, and there's services which are going to be performed somehow in connection with that sale, this is not uncommon. So if we think about the rules, okay, for foreign-based company services income, we say, remember, a related party is involved somehow, and the location of the services outside the country of incorporation. Now, if we go into our rules, specifically on what it means to be a service on behalf of a related party, we'll find some rules that will, I think, reasonably encompass this as being services on behalf of a related party. So we end up, as a result of this, with Australia having 4 million on a gross basis, 4 million of foreign-based company services income. We would then, to try to carry through the full example, we would then, under the 954C5 rule, which says you allocate deductions, we would have to calculate the net income attributable to that 4 million of gross income. We would then look at the level of effective Australian tax and any tax that might be imposed by the countries where the services are performed. Remember, if we're doing a major project like this and a bunch of Australian employees are over here in Japan or over here in Korea, maybe Japan or Korea will want to tax some of this. So the Australian company might be not only subject to Australian tax, but might be subject to Korean, Japanese, Indian, or other taxes. And they could be assessed either on a net basis, on the assumption that there's a permanent establishment, for example, or perhaps on a gross basis. Depends on whatever the local rules and any treaty that applies. And if there's a treaty that applies, it will not be a U.S. treaty. It will be a treaty between Australia and Japan, a treaty between Australia and Korea, between Australia and India. Those are the treaties that would apply and that you'd have to look at. So you look at what taxes are imposed by all these countries on that 4 million of revenue minus the expenses to get the net income. What is the effective tax rate on that net income from the 4 million of revenue? And you can see whether the effective tax rate is at the 31.5% or above level. If it is, then that high tax rule would allow you to not treat this as subpart F income. If it's below, if the effective tax rate is below that 31.5%, which you find again in 954B4, if it's below that, then no choice. WIN has to recognize a 951 inclusion of the net income from that 4 million of revenue. And of course, it will also get a deemed paid foreign tax credit to the extent of taxes that relate to that. Any questions on this? Because I'm trying to carry the example from the designation of it as foreign-based company income and an inclusion in income and so on. Yes?
In this case, does the Australian tax rate will be counted for the purposes of 904B4? Or how it's possible to calculate if the Australia has employees working in another country?
Well, you'd have to calculate it based on whatever the facts are. In other words, the methods you use will be determined by the circumstances and factual background. So, for example, those of you who have been inside a law firm probably know that a lot of the billing of clients is based on an hourly rate. Each attorney has, an hourly rate. How much are you worth, Ricardo, in dollars and cents? There might be a difference. I can't believe that. You cannot believe how many times I have discussed with young staff people as why they should believe that they are in fact worth the amount that they are being charged for. If you don't believe that you are worth $300 an hour, you will have trouble getting a client to pay it. So you have to believe it yourself. Now, some of you may think this is just drinking Kool-Aid, but there is some reality to this. In any case, the point is that installation services like this probably in a lot of businesses will be, let's say the revenue is based on an hourly rate. In another type of business, maybe the services are priced in some other way. So you really have to look at the nature of the business and say, okay, how do I determine how much of that revenue is attributable to the actual activities outside the country of incorporation? Does that help the question?
Yes and no. So I was talking about the rate to compare with if you want to exclude this income, you should to compare the highest rate, the highest rate with.
Oh, well, this is again a computation which is done on sort of a category by category basis. In this one, there's really only one category. There's the, let's say, the income from performing these particular same type of services. And you would calculate the average effective tax rate on that income. So you'd have to look at the income, for example, from Korea. What's the Korean tax on it, and what's the...
And the average will be in this situation.
Yeah. Peter, did I see your
I
hand?
was just wondering, could you explain again how you allocated the service income with 80% up there, or 5 million, or 4 million?
Oh, I said that based on actual hours spent of the employees. In other words, I think in the write-up itself, which you have, I think I said that they estimated that it would be 2,500 hours in total to do this work, and that of that 2,500, 2,000 hours would be spent physically outside of Australia. Again, it's a question of factually what's the nature of the business.